Okay, let's unpack this. Have you ever, glanced at a company's financial statements and felt like you needed a Rosetta Stone just to figure it out? Terms like financial instruments, they can seem incredibly opaque, right? But here's the thing. These aren't just accounting jargon. They're really the fundamental building blocks of a company's financial health. They show how they manage what they own, what they owe, and even some of the more complex financial deals they get into. So today, we're diving deep into that world.
Exactly. And our mission today is really to cut through some of that complexity, especially around key accounting standards like IFRS 9 and IAS 32. Now, they sound intimidating, I know, but understanding them is absolutely essential if you want to get a real feel for a company's financial pulse. So we're going to try and simplify these concepts, give you some clear examples, and really highlight the critical insights, hopefully helping you get informed, quickly and thoroughly.
All right, sounds good. Let's jump right into the foundation then. Financial assets. So basically what a company owns. And within this, we'll look at two main types: investments in equity and investments in debt. First up, equity.
Okay, so equity instruments. Typically, that means shares a company has bought in another company, but we're usually talking about holdings that aren't, large enough to give them control or significant influence, just an investment. Now, the default way these are classified under IFRS 9 is fair value through profit or loss, FVTPL for short. What that means is any costs to buy the shares, like broker fees, they're immediately expensed, straight to the P&L.
Okay, right away.
Right away. And then at the end of each year, the investment gets revalued to its current market price, its fair value. Any gain or loss from that change in value also goes directly into the profit or loss statement.
So it's a very direct, immediate impact on reported profit.
Exactly. Very immediate reflection of market movements. But there is an important alternative: fair value through other comprehensive income, or FVTOCI. Now, this is a choice, an election, a company makes when they first buy the investment. And, importantly, it's irreversible. You can't change your mind later.
Okay. So it signals intent right from the start.
Precisely. It's generally chosen for investments they plan to hold for the longer term, not ones they're actively trading. And the key difference is how those changes in fair value are treated. Under FVTOCI, the transaction costs, those broker fees, they're capitalized.
Meaning they become part of the investment's cost on the balance sheet.
Exactly. Added to the initial cost. And while the investment is still revalued to fair value each year, the gain or loss doesn't hit the main profit or loss statement. Instead, it goes into something called other comprehensive income, OCI.
OCI, right. I've seen that. It's sort of a separate section below the main profit figure.
That's the one. Think of it like a holding area for certain gains and losses that affect the company's overall wealth, but aren't considered part of its core operating performance for that period. You'll see it accumulating on the balance sheet, often in a separate reserve within equity, sometimes called an investment revaluation reserve. An interesting little point here: unlike, say, property revaluations, this reserve can actually have a negative balance if the investments lose value.
Huh. Interesting. And what happens if they eventually sell that FVTOCI investment? Does that accumulated gain or loss ever hit the main profit?
Good question. When it's sold, the rules allow the accumulated surplus or deficit in that OCI reserve to either just stay there or it can be transferred directly to retained earnings. It generally doesn't get recycled through the profit and loss statement for equity instruments.
Okay, that distinction is huge. FVTPL for active trading, immediate P&L impact. FVTOCI for long-term holds, value changes go to OCI, signaling a different strategy. Now, let's shift focus to debt instruments. This is things like bonds, loan notes, stuff that usually pays interest and you get your money back at the end. Here's where it gets really interesting, you mentioned.
Yes, because classifying debt instruments isn't just a choice, like with equity FVTOCI. It involves two crucial tests. You have to meet both. First, what's the company's business model for managing these assets? Are they primarily holding them just to collect the interest and principal? Or is their model about selling them too? And second, you look at the asset itself. Are the contractual cash flows solely payments of principal and interest? Or is there something else going on?
Okay, two tests: business model and cash flow characteristics. So how does that play out?
Well, let's start with debt instruments at amortized cost. This is the classification if the business model is to hold the assets to collect those contractual cash flows, the interest and principal. And critically, the cash flows must be solely payments of principal and interest, SPPI, as it's often called. Let's use an example. Say a company lends out $10 million. It's structured as a 5% loan note, meaning they get $500,000 cash interest each year. But maybe the deal is that at the end of the 3-year term, they actually get $11 million back. So there's a $1 million premium on redemption.
Right, so they get the annual interest plus an extra lump sum.
Exactly. Now, IFRS 9 requires you to use something called the effective interest rate. It's not just that 5% coupon rate. It's a calculated rate. Let's say it works out to 8.08% in this example, that truly reflects the total economic return over the life of the loan, including that $1 million premium. This effective rate is then applied to the outstanding balance of the loan receivable each year to calculate the investment income recognized in the P&L.
Okay, so the income isn't just the cash received.
No, it's based on this effective rate applied to the carrying amount. Let's walk through it quickly. Year 1 starts with $10 million. Apply the 8.08% effective rate. That's $808,000 of investment income recorded. They receive $500,000 cash. So the balance goes up by the difference, $308,000, ending the year at $10,308,000.
Ah, I see. The recorded asset value increases because the calculated income is more than the cash received.
Precisely, and this continues. Year 2, you apply 8.08% to the new balance of $10,308,000, giving slightly higher income, say $833,000. Receive $500,000 cash, balance increases again. It keeps growing, reflecting that accrued premium, until at the end of year 3, the balance hits exactly $11 million ready for redemption. The total income recognized over the 3 years, $808K plus $833K plus $859K, was roughly $2.5 million, perfectly captures both the $1.5 million total cash interest received and that $1 million final premium.
That's clever. It smooths out the total return over the loan's life.
It does. It reflects the economics accurately each year. Now, the next category is debt instruments at FVTOCI. This applies when the business model is both holding contractual cash flows and potentially selling the assets, maybe for liquidity, maybe to manage yield. The cash flow characteristics test, solely principal and interest, still has to be met.
Okay, so hold and sell strategy. How does the accounting work then?
It's a hybrid, really. You still use the amortized cost method, just like we discussed, to calculate the interest income that goes into the profit or loss statement using that effective interest rate. But at the end of each year, you also revalue the asset to its fair market value. The difference between the amortized cost carrying amount and the fair value goes to OCI.
Ah, so similar to equity FVTOCI in that respect, using OCI for the market fluctuations.
Similar, yes. But with a key difference for debt FVTOCI, when the instrument is eventually sold, that accumulated gain or loss sitting in OCI can be reclassified or recycled into the profit or loss statement.
Okay, that's a notable difference from equity FVTOCI. Got it. And the last one?
The last one is debt instruments at FVTPL. This is basically the default or catch-all category. If a debt instrument doesn't meet the criteria for amortized cost or FVTOCI, maybe the cash flows aren't solely principal and interest, or perhaps it's held specifically for trading, it lands here. And just like FVTPL for equity, all changes in fair value, including interest received, go straight to the profit or loss statement. Very direct market impact.
It's really quite something how the company's intention hold, and sell, or trade alongside the nature of the cash flows drives such different accounting and reporting outcomes. That leads us neatly to the other side of the coin. Financial liability is what a company owes. We're focusing mainly on how these are often held at amortized cost, which sounds like it might echo what we just covered for assets.
It does echo it, yes. The principle of amortized cost measurement is very similar, but obviously we're looking at it from the borrower's perspective. So instead of investment income and an asset, we're talking about interest expense and a liability. But there's a major difference right at the start. The initial recognition. Liabilities are initially measured at their net proceeds.
Net proceeds, what does that mean exactly?
It means the actual cash the company received, minus any transaction costs they paid to issue the debt, like legal fees or broker commissions. So let's take an example. Say Oviedo Co. raises $10 million by issuing loan notes, but they had to pay their brokers $200,000 in issue costs. They don't initially record a liability of $10 million. They record it at $9.8 million, the net amount they actually got in their bank account.
Okay, that makes sense. But what happens to that $200,000 fee? Is it expensed immediately?
No, and this is crucial. That $200,000 issue cost is not immediately expensed. Instead, it gets deducted from the initial liability, and then it's effectively spread or amortized over the life of the loan as part of the interest expense calculation using the effective interest rate.
Ah, so it increases the total borrowing cost recognized over time?
Exactly. It becomes part of the calculation for the effective interest rate. This rate will be slightly higher than if there were no issue costs, ensuring that the true economic cost of borrowing, including those fees, is recognized systematically. Let's stick with Oviedo Co. They issued $10 million, 5% loan notes, paid $200 CAC costs, so started with a $9 miller liability. Let's also say they have to repay them at a $1 million premium, so $11 million total repayment, just like the asset example, but from the other side. All this, the lower initial amount, the annual coupon, the premium, gets baked into calculating the effective interest rate, which might work out to, say, 8.85%.
Okay, higher than the coupon rate because of the fees and premium.
Right. So year one starts with the $9.8 million liability. The interest expense recorded in the P&L is 8.85% of $9.8 million, which is about $867,000. They make the cash interest payment based on the 5% coupon rate, $500,000. The difference, $857K, $500K Dracula was $367K, increases the liability. So the balance at the end of year one is 9.8 millers plus $367K equals roughly 10.167 million now.
Precisely. The interest expense calculation each year, using the 8.85% on the increasing balance, implicitly includes a portion of that initial $200 hedge issue and the eventual $1 reader premium. By the end, the total interest expense recognized over the 3 years correctly reflects all the costs of borrowing. The $1.5 million cash interest paid, the $1 million premium, and that $200,000 issue cost. It's all neatly amortized.
That's a really elegant way to match the true cost of financing to the periods it relates to. No big hits up front or at the end. Okay, now for what sounds like the most complex part, convertible instruments. These are fascinating. They give the holder a choice, right? Repayment in cash or conversion into company shares. That's exactly right. And that choice creates a real headache, well, an accounting challenge for the company that issued them. Because the ultimate outcome is uncertain. Will they pay cash or issue equity? The accounting standards, specifically IAS 32, require them to reflect both possibilities from day one. They have to split the instrument into a liability component and an equity component right at the start.
Split accounting. Okay. How on earth do they do that? How do you value the choice part?
It's quite clever, actually. You start by figuring out the liability component. You calculate the present value of all the future cash payments the company is committed to make. That's the annual interest payments and the final principal repayment, assuming it's not converted. But here's the key. You discount those cash flows using the market interest rate for a similar debt instrument that doesn't have the conversion option.
Okay, why use the rate for a non-convertible bond?
Well, think about it. Why would an investor accept, say, a 5% coupon on a convertible note when they could get maybe 8% on a similar regular bond from the same company?
Because of the valuable option to convert into shares later if the share price goes up.
Exactly. The holder is willing to accept a lower annual interest payment in return for that potential upside from conversion. So that difference in rates reflects the value the market implicitly places on the conversion feature. By discounting the cash flows at the higher non-convertible market rate, the 8% in our example, we're essentially calculating what the liability would be worth without the equity feature.
Got it. So that gives you the pure debt part. What about the equity bit?
The equity component is then simply the balancing figure. It's the difference between the total cash proceeds the company received when they issued the convertible instrument and the liability component we just calculated. So if Oviedo Co. received $10 million cash and we calculate the present value of the liability component using the 8% market rate to be, say, $9.229 million, then the equity component is the difference. $10 million minus $9.229 million, which is $771,000. That represents the value of the conversion option that the investors effectively paid for by accepting the lower 5% coupon.
Wow. Okay. So how does that look in the accounts initially?
On day one, Oviedo Co. gets the cash, debit cash, $10 million. They then credit the liability component. Credit convertible debt, $9.229 million. And they credit the equity component. Credit reserve for convertible debt or similar equity reserve account, $771,000. Importantly, that equity piece goes into a reserve within equity, not straight into share capital or share premium at this stage.
And what happens over the life of the convertible?
The equity component, $771K, just sits there in reserves unchanged. But the liability component, $9.229 million, is then accounted for using the amortized cost method, just like the rate or liability we discussed earlier. It will grow over the 3 years using the effective interest rate based on the initial calculation, the 8% market rate in this case, until it reaches the full $10 million principal amount by the maturity date. The annual interest expense charged to P&L will be based on this 8% rate applied to the carrying amount of the liability.
Okay, so the liability part behaves like normal debt, growing towards repayment value. And then at the end?
At the end, one of two things happens. Either the holders don't convert, And Oviedo Code simply repays the $10 million cash. The liability is cleared. The equity reserves might then be transferred to retained earnings, or if the holders do convert, say, into 10 million shares, then the $10 million liability is extinguished, and both the $10 million liability amount and the $771,000 equity reserve are transferred into the main share capital and share premium accounts. Debt effectively becomes equity on the balance sheet.
What a journey. We've really peeled back the layers there on financial assets, liabilities, and those quite intricate convertible instruments, all governed by these key standards, IFRS 9 and IAS 32. It definitely sounds complex initially, but breaking it down like that, you can see the logic, can't you?
Absolutely. And if we connect this to the bigger picture, getting comfortable with these concepts is just so crucial if you really want to understand a company's financial health and its strategies. It's about moving beyond just, looking at the headline numbers. It helps you grasp the nuances of how value is created, how it's held, how it's financed, and how it can transform over time. It really does give you a much richer perspective.
So what does this all mean for you listening in? Well, maybe consider how these different accounting treatments we've discussed, they don't just reflect transactions, do they? They also reflect the intentions and the strategies of the company's management. Think about that. How might understanding whether an investment is FVTPL versus FVTOCI, or how liability costs are amortized, or why a company uses convertibles, how might that change the way you interpret their financial reports? What hidden stories could these accounting choices tell you about their long-term vision versus maybe just focusing on short-term gains? Something to think about. We definitely encourage you to take these insights and perhaps do your own deep dive. Pull up a company's annual report, look for these instruments in the notes. You might be surprised at the strategic thinking you can uncover just by understanding the accounting.